You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. 2025 kicked off with bold policy announcements for President Trump's return to the White House, including tariffs, stricter immigration policy, and promises to slash government spending. The economy ended this year avoiding a recession and without a material increase in inflation, but the unemployment rate has risen to 4.6% and economic sentiment is exceptionally pessimistic. Labor market weakness warranted 75 basis points of Fed easing in 2025, but the fate of monetary policy next year is highly uncertain, given the differing opinions within the FOMC, the rotation of policy voters, and a new Fed chair set to take the helm next summer. On today's episode, we talk with FHN Financial's chief economist Chris Lowe and senior economist Sophia Kearney-Lederman about the biggest macroeconomic stories of 2025 and what we think will be the most important things to watch in 2026. Stay tuned. Coming up soon, our 2025 Year in Review with FHN Financial's Chris Lowe and Sophia Kearney-Lederman. But first, a quick market update. Some important data reports postponed by the government shutdown were finally released over the last 2 weeks. Nevertheless, the shutdown disrupted data collection and distorted some economic behavior, causing investors to view the reports with a large grain of salt. Private payrolls growth was decent between October and November, but the unemployment rate rose to 4.6% in November. The BLS noted that the margin of error for the unemployment rate was larger than usual because the shutdown interrupted the typical schedule for the household survey. Retail sales were stronger than expected in October, but because the BLS could not collect prices that month to publish a CPI, it's hard to know how much of the strength in retail spending was because of higher prices. Also last week, the November CPI rose 2.7% year-on-year headline and 2.6% year-on-year core, far below the consensus expectations. Traders quickly keyed into a few important caveats and gave a minimal reaction. For example, in the absence of October data collection, the BLS assumed rental prices for one of its 6 survey cohorts did not change in October. This decision had a big impact on the November CPI and will understate shelter inflation for the next 5 months. Considering some of the more obviously distorted components, there are still few signs underlying inflation got worse the last 2 months. Chicago Fed President Austin Goolsbee, for his part, said there was, quote, a lot to like, end quote, in the November CPI. We doubt hawkish Fed officials will be swayed either way, but the FOMC will see December data for inflation and the labor market before its January decision. This week, third quarter GDP rose a remarkable 4.3% at an annualized rate, far exceeding the 3.3% consensus expectation. The Treasury market did sell off after the report, bringing yields on benchmark tenors close to testing recent highs, but here too the headline likely diverged from reality. Excluding the most volatile components, underlying growth was probably closer to 3%. That's all for the market update this time. Now our discussion with Chris Lowe and Sophia Kearney-Lederman. We have 2 guests returning to the podcast today for our third Year in Review episode. Chris Lowe, chief economist with FHN Financial. Chris, thanks for joining.
Yeah, good to be here, Will.
And Sophia Kearney-Lederman, senior economist with FHN Financial. Sophia, good to have you back.
Thanks for having us back. Can't believe it's been another year.
Indeed, 2025, a year full of proverbial ink spilled on things like tariffs, Doge, the Fed's political independence, and the promises of AI. But through the constant flow of those big headlines and persistent uncertainty, as we're recording this in mid-December, a lot of things sound curiously familiar. So core inflation is basically 3%. The economy should grow just under 2% this year. 10-year Treasury yield is just over 4%. And the unemployment rate did go up this morning to 4.6%, but it is still low by historical standards. Before we get into all the exciting things that happened in the 2025 macroeconomy behind those numbers, let's start by revisiting the indicators we all picked in the 2024 Year in Review episode that we thought would be important to watch in 2025. So, Sophia, why don't you start us out? I believe your indicator was the foreign-born workforce. What happened there?
Yeah, I thought that was going to be a really important one, and I will say it was, but it wasn't as important as probably I thought it was going to be, right? It didn't dominate the headlines in the same way that I thought it would be. So the foreign-born workforce, well, we definitely did see that come to pretty much a standstill, right? We had immigration that pretty much started to stop in the summer of 2024, borders fully closed. We started to have deportations. And the supply side of the labor force has definitely been something that the Fed has talked about, right? But the bigger thing I think in the labor market has definitely been the slowdown in hiring, more so than the foreign-born workforce. And so I think it's definitely still super important, right? You have people like Chair Powell that have mentioned that in the labor market, there is a supply factor, right? That we haven't seen that growth coming from the foreign-born workforce. But it really was the demand side that I think ended up being a lot more important than I would have thought at this time last year.
To be fair, though, it is the reason the hawks on the Fed, people like Jeff Schmidt, for example, are still talking about the labor market being roughly in balance, despite the fact that the unemployment rate has been rising for the past 6 months. Not everyone on the Fed is convinced employment is weak because of not just lack of growth, but really its significant decline in the foreign-born workforce.
Yeah, Sophia, I have to give you a little bit more credit here. I think that the ambiguity of what break-even job growth is right now, that slower labor force growth from stricter immigration enforcement, is kind of at the crux of the disagreement within the FOMC. I do agree that labor market weakening more has to do with labor demand than labor supply, but I don't think we'd have the same bifurcation if we didn't have the abrupt change in the foreign-born workforce, which, by the way, is very difficult to measure in real time.
Yeah, and I think it's giving myself more credit because thank you. It gets a little lost in the sort of bigger picture, I think, right? When you look at the labor market as a whole. But in certain industries, it's definitely been an enormous factor, right? You think about industries that rely heavily on foreign-born workforce. I think restaurants, think agriculture, and you've definitely heard signs there. The other thing that I will mention that I hadn't even thought about when we talked about this last year, or when I thought about it as a factor, is it's also a factor for consumer base. We had people coming into the U.S. in large numbers in 22, 23. We had more consumers. And so that I think has also been a factor in certain industries. I think about restaurant spend, where you have less people coming in to grow the consumer base. That's also been a factor in, some of the maybe softness in certain industries.
It's also affecting rents. The big decline in the number of immigrants who need housing, especially in cities that saw big population increases in the last couple of years. We're starting to see lower rent numbers, and that's going to be a big part of the story, I think, in 2026, as long as the trends in immigration continue going the same way.
Chris, why don't we move on to your indicator that you had to watch for this year was the Fed's long-run Fed funds forecast. How did that turn out? Was it as important as you expected?
I think a little bit like the foreign-born workforce, we both got ahead of ourselves. I suspect it's probably going to be a bigger one next year than it is this year. But to be fair, one of the significant factors affecting FOMC participants' decision-making this year has been where they think the neutral rate is. And a couple of them, Beth Hammack and Jeff Schmidt, again, have talked about why they opposed rate cuts in September, October, and December. And both of them saying that one reason is they don't think policy's restrictive anymore. So they think we're at that long-run neutral already. Obviously, that's not a universal view, but we did move this year from a level of Fed funds everybody on the Fed thought was restrictive to a level now that's within the range of those estimates. And as a result, it changes the math going forward on whether or not it makes sense to cut.
I think that's right. There is the difference in how they're viewing the risks of current economic conditions, but how restrictive policy is, or whether it's restrictive at all, I think goes a long way in explaining the differences within the FOMC as well.
And to give you some credit, Chris, the Fed probably with the uncertainty that started brewing at the end of Q1 of this year probably would have cut sooner, which would have gotten them into this place that they've gotten in eventually at the end of this year, where technically, if we look at the December dot plot from a couple of weeks ago, we are now within the range of long-run Fed funds projections based on where the dots are. So we did get a little ahead of ourselves, but 2025, I think, for everyone did not pan out exactly timing-wise as we were expecting as we headed into it.
It's good that your thoughts are leading indicators rather than lagging indicators, right? If you were picking things that were really important 2 years ago, that's a pretty easy mistake to make.
All right, but to be fair, what was the most important indicator in 2025? Looking back, I would argue it was non-farm payrolls, job growth a lot weaker than expected, and the entire justification for the 3 cuts we got was because the risks on the employment side of the mandate superseded the risks on the inflation side, even though, as you pointed out at the beginning of the podcast, Will, inflation is still running hotter than target.
I think that's a good point, and we're going to come back to actually recapping 2025 in just a bit. But before we go on to everyone's favorite, the trivia section, I'll revisit my indicator to watch, which was Medicare spending. And my thinking here was that there was this big push after the November elections to rein in government spending, find lots of ways to make the federal government more efficient. And considering how big of the budget Medicare spending is, this was a place where we could improve costs without lowering services. Looking back on it, I'd like to take the win here, but I don't think that ended up being the focus at all. It turns out that the improvement in the budget that we saw so far this year was from an increase in revenues from tariffs. So the One Big Beautiful Bill Act, a lot of it was renewing existing tax and spending policies. And then the cut in Medicaid spending, which could be in part some improvement in efficiencies, won't take place until 2027. So I guess I could take the win by saying that the budget improvement didn't have to do with eliminating waste, fraud, abuse, but I don't think that a lot of people saw the biggest contribution would be from this increase in tariff revenues.
Yeah, that wasn't on my bingo card for 2025, but I'm going to put a lot more things on my card for 2026, I think.
Yeah, look, there was an article in the Journal today about how everyone from the president to economists got the tariff story wrong. And I would say, when you think about it, a year ago, we were worried about the inflationary impact. We were worried about the growth impact. And very few people were talking about the potential budget impact. Turns out the budget has been the bigger part of the story.
So moving on to the trivia section, I think in the first year we did this, it was a bit too challenging, and last year you guys did better. Hopefully this year is the sweet spot. I went through our month in review and quarter in review documents from earlier this year, and sometimes it is really an odd reminder of how long a year can be and how long ago some of these things feel. So this question has to do with something that happened in January. What is the name of the Chinese AI company that topped Apple's App Store charts in January that drove a huge sell-off in US tech stocks? You guys can work together if you want. This is collaborative, or it can be a competition, whatever you feel is appropriate.
I don't know. I can jump in on this one if you want. It was DeepSeek. DeepSeek, the shockingly cheap compared to US AI, was looked, at least in the beginning, like performing just as well. But you'll notice we haven't heard a whole lot about DeepSeek since January.
Yeah, I was going to say, I haven't heard it come up on my radar in a very long time.
Yeah, it's partly because, when you release something like this, users always see the challenge to find the bugs, and they found a lot of them in the first few months. One of them, it is a Chinese AI. So on certain topics like Tiananmen, it's going to be trained not to tell the truth. And training an AI to lie is, well, according to some of the experts anyway, sort of a guarantee of AI insanity.
Will, I also went back and looked at our month in reviews to prepare for this as well. And I have to say, when I looked at our January one and read that DeepSeek, I went, wow, I totally forgot about that.
Yeah.
It feels like it was so long ago. And then thinking about it now, right? If I would have put myself in those shoes, it would have been a great moment to go, wow, maybe this year will be a lot about AI. But I think in the moment I didn't have that thought. And so it was funny to look back and be like, huh, that was a pretty tumultuous time in January.
Yeah, definitely. I mean, people thought that it was going to be a big threat to the U.S. tech companies, but as Chris said, a lot of that fizzled out. So that is a correct answer. Moving on to question 2 of 5. The tariffs this year, of course, were one of the aims was to narrow the trade deficit the U.S. had with a bunch of foreign countries. So after the big ones were first instituted in February, we know that the April 2nd tariff announcement, of course, was applied to all countries, but the first ones really started happening in February. So between March and September, September being the last month we have data for, with which trading partner does the U.S. have the largest trade deficit?
The biggest trade deficit, bilateral trade deficit, I would have to say it's probably Mexico.
I was going to say Mexico. Switch from China to Mexico.
The answer is Mexico. And what I will say is there's a little bit of cherry picking here with the timeline, because I think after the November elections, that's when the front running began with China. So if you look at the 12-month trends, China is narrowing and Mexico should surpass it pretty soon. But for this March and September time period, Mexico was the largest trade deficit, and maybe by design that is shifting our deficit away from China and more towards Mexico.
When you look at the trade data, of course, the deficit exploded in the first quarter because companies were rushing to get goods in before the tariffs hit. But since March, the deficit has narrowed considerably. On average, in fact, narrower than it was in 23 or 24. So it's moving in the right direction in terms of, intended impact.
I'll also say there's probably a little bit of a dotted line from Mexico to China, as there has been a lot of Chinese investment in Mexican manufacturing. So coming from Mexico, but it all gets a little fuzzy, I think.
Yeah, I think that's a good point.
That's a very good point.
So I went back and read all of Chair Powell's speeches this year. As you would expect, a lot of them talk in the same technocratic language, and there's nothing too interesting or worthy of a podcast trivia episode, but I did find 2 questions I think worth asking. In honor, of course, of Powell's long tenure that is coming to a close in the first half of next year. So the first question is, what Chicagoan did Chair Powell quote in an April presentation at the University of Chicago School of Business saying, quote, "Life moves at you pretty fast," end quote?
Wow. That's a pretty general statement. I'd say, thinking of Chicagoans, it could be Milton Friedman or it could be Oprah Winfrey. But Sophia?
Was it from a movie? I don't know why, but my gut instinct is Ferris Bueller, but I don't know if that was in Chicago.
It was in Chicago.
That's my gut instinct.
As someone who grew up in the Chicagoland area, this quote was like half of people's senior quotes in the yearbook. And so I've heard it so many times. So maybe to me, I thought it was low-hanging fruit. But the answer is Ferris Bueller.
It's also been a little while since you were in high school, Will.
Nonetheless, you see this on like people's shirts. It's just, I don't know, a thing that Chicagoans feel really, enough for Chair Powell to cite it, I guess.
The only reason I kind of remember that is because I kind of remember hearing the speech or the talk or reading it and going, wow, the chair using a movie quote, really normalized media.
As you would expect, he's got to keep things pretty serious, but every once in a while he can give a somewhat cute response, 1 out of every 1,000 paragraphs or something. So the next question again is about Chair Powell. In an October speech, he used what event to describe the joys of discussing the Fed's balance sheet management?
Going to the dentist, right?
That is correct.
Yeah, very good.
That is correct. Yeah. For some reason, I remembered it specifically as getting a root canal, but you're correct. It was going to the dentist.
It's about as exciting as going to the dentist.
And I think he even said, with credit to the dentist, no offense to dentists, he'd rather go to the dentist than talk about balance sheet management.
He didn't want us thinking about it, right? And
Exactly.
so he didn't want the market to focus on the switch from QT to expanding the balance sheet again. So why not set it up that it's boring?
The last question, now that you guys are 4 for 4, I guess next year I've got to go back to making them annoyingly difficult. The biggest intraday move for the 10-year Treasury.
I actually also looked this up. Oh, the biggest move, was it January 13th? No, wait. Biggest one-day move, increase or decrease?
The biggest intraday range.
It was an increase on April 17th.
Is that your guess?
Yeah.
I think it's actually April 7th. The yield was bounding higher because of the tariff announcement.
The correct answer is April 7th. Chris, I don't know if you took this as an open book quiz. I saw you maybe look at your computer screen. If not, that's okay.
No, this is the Will Compernol, annual podcast. And I've learned from prior trivia questions, I opened the 10-year note chart before I dialed in.
I will say I read the L as a 1 on my notes. In classic me fashion, Will, I actually have too much data on my cheat sheet instead of too little.
It can be pretty difficult to come up with trivia questions about the Treasury market. If you're not going into the minutes of the Treasury Borrowing Advisory Committee to pick up with word choice. So I'm glad you picked up on the trend. But anyway, April 7th, it was the Monday between the reciprocal tariff press conference and the 90-day pause. So as I understood it, it was right after the weekend where people were sort of thinking, oh, is this really happening? And then there were all these technical adjustments. So the range was between 3.88% and 4.22%, which for a lot of actually the rest of the year has proved to be support and resistance, interestingly enough.
Yeah, looking back at this handy chart that I just happened to have open, the volatility in April was extraordinary. Since then, we've had less volatility than in any year I can remember. It's been a very range-bound market, continues to be a range-bound market. And, I think we'll probably be struggling to find direction for the next few months.
The headlines were so volatile and people were always talking about this elevated uncertainty. And then you look at some indicators and they've been remarkably stable. So even the 10-year Treasury yield, there was a bit of a downtrend between May and September, and then it's been pretty range bound. So I think that is a really interesting way to look at 2025. So let's move on to 2025 and everyone's indicator that we think sums up this year. Chris, you might have already alluded to your choice of non-farm payrolls. If you have something else, that is also okay. But what do you have for us?
Definitely non-farm payrolls. And, it's amazing when you consider the fixation on inflation and tariffs. It ultimately ended up being the weakness in the job market that was the biggest surprise and prompted the most, certainly Fed movement, but also market movement.
Yeah, I think it's a good point. And as we talked about earlier, that disagreement about what break-even job growth is still hanging over the Fed as we go into 2026.
Absolutely. No, there's no question. John Williams yesterday saying he thinks the risks on both sides of the mandate are in balance, but that could change by the January meeting. And indeed, maybe it changed with the release of all that employment data we got this week.
My indicator that I think sums up 2025, I never really thought that I would place focus on this when given a platform like a Year in Review podcast episode, but in trying to think of something that really tied together so many different stories we had this year, I'm going to say it's gold. So the price has gone up 65% this year, which is pretty big. It was also responsible for huge swings in the international trade balance. You might remember that it forced the Atlanta Fed's GDP now to make a very unusual change to the model within a quarter because investors were moving it from Switzerland to the US. They were trying to get ahead of tariffs. And so you have this combination of global sovereign debt worries, institutions looking for ways to diversify away from the dollar and treasuries, sensitivity to tariff announcements, and I think something we all love now, which is understanding the quirks of how we measure official data. So even though gold was showing up in that monthly trade balance data, the BEA does not include it in their GDP calculations.
Right, because it's a financial asset rather than a good or service being imported. You're right. And, the irony is the Atlanta Fed was calculating trade the wrong way all along. It never made a difference until the first quarter of this year.
Yeah, finished metal products and non-monetary gold. Those are terms I don't think I heard much before this year. And then they were like the only thing for a couple news cycles.
Yeah, we had to redo our whole file on the Atlanta Fed GDP now because of that switch.
Yeah, one of the biggest market movers. Sophia, let's go to your indicator that you think sums up 2025.
I would say if I had a tagline for 2025, it would be uncertainty is the new norm. Right? I think that that's sort of what we were talking about in this after all the sort of volatility of April, we all normalized to the uncertainty. Indicator-wise, one that I think sums up 25 and will continue to, it's going to be business investment tied to AI. Not just because of its contribution to growth, but also because what it's meant and what it will mean, most likely, for the level of growth that we can tolerate without being worried about inflation, but also what it means on the labor market side, right? There's definitely a component of that slowdown in hiring that is tied to businesses funneling investment into technology that doesn't require as many people. And so I think it's at the sort of crux of what we will probably be dealing with as we go forward. And I think we probably all wouldn't have expected it to be as a big factor in 2025 as it has been.
I think that's a good point. Your last point, especially that I think ChatGPT's big launch was maybe November of 2022. And so it's always been in the background. But then this year, Q2 and Q3, the GDP contribution from AI data centers and software just really surged. If you take those out, economic growth is really a different story. I don't know if people really expected the timing of that to happen in the second quarter, especially when interest rates were still pretty high.
Yeah, and I think some of it was just coincidental timing. I think tariffs played a factor, right? You think about some of that front running and investment that happened probably before tariffs went in, particularly with China. But some of it is also, I think, necessity is the mother of invention, right? And in uncertain periods, businesses were looking at, is now a good time to hire with so much uncertainty in the middle of the year about what does the forward projection look like, that they made investments in technology that maybe seem a little bit more lucrative in the longer term than thinking about hiring more people and building more workforce.
Yeah, look, it's also the crux of the productivity growth Jay Powell talked about in the December press conference. He said it's not all AI, but AI is a big contributing factor in explaining the breakdown between rapid GDP growth and sluggish job creation. And boy, the data just continues to show that split widening.
Now, I want to move on to everyone's choice for what surprised you the most in 2025. I'm going to go first here because, well, maybe we all have the same answer. So I'm going to, take the first step. And that's, I think, the impacts of tariffs, with the caveat that I think we'll still see some lagged impacts next year. There wasn't as much pass through to consumer prices as most people expected. The economy survived the roller coaster of policies going back and forth, not only the actual policies, but also the uncertainty. And the stock market is doing well, and so profit margins weren't totally destroyed by it. So at this point, I would call this a very successful corporate income tax. And what I mean by that is that, I know the label doesn't appease anyone's political narrative, but we have this new tax that has significantly raised revenues without leading to all that much job loss or increase in prices. And against the design of the policies, I don't think they've even changed business behavior all that much. What do you guys think of that, about the idea that this is really just a corporate income tax that hasn't been as distortionary as most people would think?
I think that's pretty close to spot on, Will. When you read all the Fed research that's been done, normally you would expect to see a very significant economic impact. This is the biggest tax increase in American history. The history suggests we should have had a recession in reaction to it. It hasn't happened. I do think a big part of it, if you look at import price data, which is reported without the tariffs in them, the rate of import inflation has slowed down from 2.1% to about 1%. So it suggests foreign companies are absorbing maybe a percentage point of the tariffs. The rest of it, a lot, has been absorbed by corporations. Happened to go into this year with record high profit margins, so they could afford to give some of that up. And then we did see some pass through, but inflation, excluding tariffs, has fallen. So, on balance, I think you're nailing it. Inflation didn't turn out to be what we thought it would. Nobody thought we'd be talking about a deficit to GDP ratio of less than 5%, maybe even before we get into the next calendar year. But boy, we're awful close. November was 5.2. So it has dramatically changed the economic and fiscal landscape in ways nobody anticipated, even the people who implemented the tax.
Chris, what's your pick for the thing that surprised you the most in 2025?
I would have to say it's the unemployment rate. I never expected the unemployment rate could rise as much as it did, with likely zero increase in the number of immigrants looking for work. And in fact, according to the agencies involved, the number of immigrants in the U.S. is about 2 million lower than it was at the end of last year. And that's because they claim they've deported over 100,000 people. They claim 1.6 million self-deportations. And then apparently there's a significant number of immigrant workers who have stopped working, stopped looking because they're laying low. You put all that together, and I would expect that the labor force would have shrunk this year. It may turn out it did, by the way. The population estimates are notoriously stale. The last estimate was made last December, before any of these policies were put in place. But the unemployment rate is a ratio, right? So it's the number of unemployed as a percentage of the number of people in the labor force. So if the population numbers are wrong, well, then both of those numbers are wrong by the same amount. The fact that the unemployment rate rose despite solid economic growth in the second, third, and beginning of the fourth, probably at least some economic growth, that to me is just amazing. And it reflects a significant change in productivity, which Sophia alluded to earlier. But it's going to take the Fed and markets a while to get a handle on whether this is permanent, whether it's temporary, and what it means.
I think something that also surprised me about that is, we had the low for unemployment rate this cycle, 3.4%, in, I believe, April of 2023. And so we did have a triggering of the SOM rule. And so historically, this would mean we're in a downturn because enough layoffs mean enough lower consumer spending, which means lower labor demand. And it's this vicious feedback loop. We have seen another increase in the unemployment rate. I mean, it was rounded up to 4.6% this morning, with some technical caveats about statistical margin of error. Even with that increase, the Fed is not totally alarmed. Maybe we survived one of those increases the first time because of big labor force growth from big migration flows, but we're taking another chance with it, that the unemployment rate, goes up 0.4 of a percentage point, and we think it's going to stabilize.
Right.
It's really playing with fire.
Yeah, we triggered the SOM rule in both 2023 and 2024 in the sense that SOM rule says if the unemployment rate rises 0.5% in one calendar year, it means you're already in a recession. And of course, we weren't. At the time, that was because rapid immigration growth was fueling labor force growth. This year, it's been the opposite. It is weak demand for labor. And, one of the amazing things, looking back at the last year, we've added so few jobs. And of course, the job gains have been incredibly narrow. The vast majority of them in healthcare, almost no job growth elsewhere. And just to pick out one little stat, I find just mind-boggling. 12-month gain in construction hiring, 30,000. In a normal year, that would be March. And now we're talking about a whole year. It really is remarkable how slow it is. Manufacturing hiring down, tech hiring down, financial services hiring down, temp workers in the last 6 months down. It's a broad range of industries that are cutting. To me, this is acyclical behavior. It's unusual behavior. And the Fed already fighting over what it means, whether in fact Fed policy is even something that could potentially turn the tide.
Will, you alluded to something that actually would probably be my most surprising thing of 2025. And that has been the resilience in consumer spending this whole year, right? It definitely hasn't been strong consumer spending, but given the uncertainty that we saw in April, given, some of what we thought tariffs would do to prices and what consumers were worried about, we really have seen consumer spending hold up. But again, it's one of those things that when you look at it on the whole picture, at the high level, it's a very different picture than when you look at it sort of one layer down, right? And a lot of people are talking about the K-shaped economy, this sort of bifurcation that you're seeing. And that definitely is one of the most surprising things I think about 2025, though, is that when we look at it as a whole, even think about, right, car sales, which, yes, were just down in the most recent October retail sales because the EV credit expired. But, we had tariff front running in cars that when I thought about it, I wouldn't have expected to see such an extraordinary front running of car sales because consumers were worried and uncertain and sentiment has been really, really low. But that probably has been the most surprising thing about 2025. And it factors into this whole Fed sort of assessment of where we are, right? If we have an unemployment rate at 4.6, but we have a consumer spending base that's still spending and growth looks okay, how does the Fed sort of deal with that? And it's something Powell has asked in the press conferences, including the most recent one, is sort of, right, people's experience of the economy right now is not uniform. And so when you say the economy is doing okay, someone like Jeff Schmid, but not everyone feels that way, I think that's probably one of the biggest things about 2025 that surprised me, not because it hasn't been going on for a couple of years, but I think because there was some expectation coming into this year that we were going to look at some of that bifurcation sort of maybe moving out if we had more sustainable, solid growth.
That's such a good point. Especially if you look at consumer sentiment, which has just been abysmal this year, particularly in the last 3 or 4 months, and beige book surveys suggesting weak consumption. But even the October retail sales, which we just got, it was stronger than expected. The car sales were terrible, but that was a tax change. The other thing about car sales is that we buy those with credit, which means we make those payments over a series of months. It's not all at once. So you look at October weak car sales, okay, that's not actually significantly lower spending in October. And meanwhile, spending on everything else, way stronger than expected.
Except for grocery stores were up, restaurants and bars were lower, right? And so I think it's some of that reflection of there is this tension in the economy and the consumer base, and you're definitely seeing it in certain sectors. But I think it's going to continue to be a really big factor in 2026. The affordability issue, particularly for lower income individuals, but also middle income individuals, is going to be a really, really big factor in 2026. Not only what it means for economic growth, but also because, ding, 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 we have midterm elections in November, and we have already seen affordability be a big factor in elections we had in 2025. And so I expect that will continue to carry into 2026.
Yeah, it's interesting from a macroeconomic perspective. You can have a lot of struggle and weakness in the bottom half of the population, but if the top 10% is doing okay, that can keep the economy chugging along. And I know that research from Moody's recently showed that share of spending done by the top 10% is going higher. But how much longer can the top 10% really keep the economy above water? I feel like there's got to be a breaking point where people choose to save instead of consume, for example. And maybe that we're going to see some sort of threshold in 2026.
So a couple of things on that, Will. One is the University of Michigan data broken down by income. The top third was doing just fine until the shutdown. October, November, they're looking a lot more pessimistic. And then in the preliminary December anyway, it was the top earners that got more negative, even as middle and lower earners were a little more positive. And I suspect that's at least partly because federal government pays its workers once government restarts, but they don't pay contractors. And there are a lot of Americans who make a living doing business with the government. And they took a bath. And they took a bath that, 43-day shutdown in the fourth quarter. It's going to be an awful quarter for a lot of those companies. The other thing that's going on, and I think this is important, is with the corruption scandal that's blown up in Minnesota and now spread to Maine, it's drawing attention to corruption within the Medicaid system that is finally resulting in a crackdown. There's also a big audit going on of the SNAP program, and that's caught a lot of people as well. There are a significant number of seven-figure income earners across the 50 states who are making money from those programs. I cannot believe for a minute that it's one group in one state taking advantage. As the audits spread, they're going to find more and more people. The way the scams were set up, they were paying taxes, they were declaring their income. They'll be showing up as high earners in the surveys. And a lot of them are suddenly not only broke, but they're going to be expected to pay that money back, probably do jail time as well. So that might be one of the things eroding their sentiment. I can't imagine they're in a very good mood this Christmas season.
Well, on that happy note, let's move on to the 2026 indicator to watch. So, Sophia, why don't you start us out? What do you think is top of your mind for next year?
I think the biggest thing is probably going to still be affordability for consumers. And I think, the biggest factor becoming housing. Not that I think anything's really going to shift necessarily in the housing market, but if we think about the way housing prices coming down has been a big factor in what we've seen in the inflation improvement, which is obviously at a lag when we look at the inflation data that we look at, but also what it means in terms of what does it mean for sentiment? What does it mean for people spending? And I don't just mean actual housing prices, right? Think about right now, one of the biggest issues that people are facing is, gas prices for your car are low, but utility prices are very, very high. And so thinking about that sort of middle, low income consumer and this bifurcation, that'll be something that I'm going to be watching in 2026, just because the housing market is one that has been completely frozen for almost 2 years now, and still is an issue, even though it's not adding to inflation in the way it was. So I think that that's going to be something maybe it can see improvement. Chris talked about that 30K construction add in payrolls, which is really low, which means there's no inventory. So do we have with lower rates, we have housing coming in and more construction starting? I think that's going to be probably one of the factors in 2026 that we'll be watching.
Yeah, I think that's always an important thing to watch, and it's a good opportunity to remember that the way that people experience inflation is through price levels, but economists often talk about the rate of change, which is inflation. And so the Fed's mandate does not say bring price levels down, which is what people want. In fact, if we did have deflation, that has its own bad effects. And so, the Fed, they declare victory if the rate of change is 2% year over year and people are still upset about price levels. So there is a tension there between what monetary policy can do and what the electorate is looking for.
Mm-hmm.
Chris, what's your indicator to watch for 2026?
Mine's CPI, and that's because inflation, I think, is back in the driver's seat in the sense that it's the one reason the Fed is still reluctant to cut rates. The Fed only has one rate cut in its median forecast in 26. but there's a pretty wide range on the dots. And ultimately, what the Fed does, it's going to coalesce around the dots, whoever's got the forecast closest to right. My own CPI forecast, I think we're going to see some significant progress in just the next few months. I've got the CPI, well, the core PCE and CPI close to 2.5 by March. I think there's a good chance the core PCE could be 2% by the end of the year. And there's a couple of reasons for that. One is that, the White House has woken up to inflation. They're aware that the midterms are coming. The president has grown quite pessimistic about the possibility of keeping seats in the midterms, but he's also talked about being determined to do so. They've renegotiated some of the tariffs on food from South America, from Europe. That's going to help the year-on-year numbers going forward, especially once we get past the tariff implementation dates. I think if the CPI does what I expect it's going to do, the Fed, in fact, is going to cut 3 times next year. So that's how important that indicator is. It allows the Fed to focus on the weakness in employment almost exclusively if inflation comes down. In fact, if it comes down to 2, it's possible the Fed could cut a full percentage point next year. But that's getting maybe a little bit ahead of ourselves. Let's maybe wait a couple of months before putting that in the forecast.
I'll jump in with my own indicator to watch, which is very simple. I thought it was kind of so predictable that it was almost contrarian, and that's the PCE Supercore. It feels like a big throwback, but I think there is, again, a disagreement within the FOMC or a lot of economists about once this tariff pass-through subsides and these one-off changes fall out of the math, what is underlying inflation? And if you remember the PCE Supercore, that's core services excluding housing. That's what the Fed wanted to use to gauge underlying inflation when the pandemic reopening was causing all these price increases. And I think we're back to using that as a helpful gauge, because whether tariffs are passed through or not, we can call it transitory, but the PCE Supercore in year-over-year terms has barely budged over the last few years. So there's, I think, been a slight downtrend the last 6 months, which to me says that even if tariffs are these one-off thing, we have underlying price pressures that you could say are above the Fed's target. One caveat I'll put with that is that even though we think of core services as not really being sensitive to tariffs, there are some important connections. So when motor vehicle part prices go up, that gets passed through to car insurance or car repairs, often with a lag, but still, of course, it impacts those operating costs. So yeah, that's my way of saying that I think the inflation indicator to watch, I agree with you, Chris, CPI is of course there, but the PCE Supercore could come back into relevance sooner than we think.
Yeah, it's a good point.
You know what I think we also have to watch? And we might know sooner rather than later, but we're going to have some shifts on the Fed. Obviously, we're going to have a new chair mid-year. And yes, this happens all the time, right? Not all the time, but the chair's term always expires because there are term limits and reappointments. But, I think that'll be something to definitely watch, particularly as we head into 2026 with sort of this range of opinions of what the risks really are, the risks to both sides of the dual mandate. So I think that'll be a big factor in 2026. Who is leading the Fed next year?
Yeah, and in fact, it's possible we could see 2 changes on the board. Stephen Myron steps down end of January, assuming someone has been nominated and approved by the Senate to take Powell's place as chair. And then Powell gets to decide on May 15th, when he steps down as chair, whether or not he stays on the board. So that'll be kind of interesting.
Yeah, the composition of the FOMC is certainly something to keep in mind. Well, that concludes the 2025 Year in Review episode of Simply Put. Thanks again to both of you for joining today, Chris Lowe and Sophia Kearney-Lederman.
Thanks, Will, for having us.
Thank you, Will.
And thanks to all our listeners for tuning in to another great year of the podcast. We'll see you soon in 2026. That was FHN Financial's Chris Lowe and Sophia Kearney-Lederman. Looking back on 2025, I think the biggest surprise was how well the economy held up given all the big federal policy shocks. If you look at some of the most important economic indicators at the end of the year, things don't look all that much different than a year ago. That being said, I think there is still a decent probability that these policy shocks will have lagged impacts in 2026, whether it be tariff pass-through to consumer prices, a slowdown in spending from federal layoffs, or a mismatch between labor demand and labor supply because of the change in immigration policies. Next week should be quiet with limited economic data and trading activity subdued for the New Year's holiday. End-of-year flows could cause some choppy moves in the bond market, though we expect recent ranges to hold. Liquidity demand also tends to rise at the end of the month, so overnight funding rates will be an important barometer for whether the Fed's recent decision to buy T-bills will make a sufficiently quick impact on short-term funding markets. The Fed minutes released on December 30th will provide some interesting color on how the FOMC decided to cut 25 basis points this month and how much informal dissent there was within the committee. The data calendar picks up the following week, beginning with the ISM manufacturing and vehicle sales for December on Monday, January 5th. The ISM services and monthly ADP employment for December follow on Wednesday, as well as the November JOLTS. On Friday, January 9th, the BLS will publish the December jobs report, expected to be much less distorted by the government shutdown than the October and November data. President Trump is also expected to announce his pick for new Fed chair any day now. Kevin Hassett was seen as the obvious frontrunner for weeks before the president said he is still considering Kevin Warsh, Chris Waller, and Mickey Bowman. Jerome Powell's term does not end until May, so the next Fed chair would not fill the position until the Fed's June decision. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.